Welcome to the Nifty Noon Podcast.
It is great to be here. And honestly, I think we all need to take a deep breath before we start today.
You are not kidding. I was looking through the stack of newsletters from this past week, we're talking January 26th to the 30th, and it didn't feel like, just another week. It really felt like we were watching history pivot in real time.
It really did. I mean, usually a news cycle is just messy, right? You get some good news here, some bad news there, it's all scattered. But this week, it had a narrative, a real arc. It felt like a changing of the guard.
Changing of the guard is exactly the phrase I wrote down. Because on one hand, we saw the sun just officially set on the NFT boom of yesteryear.
After a major closure.
And at the exact same time, you have these massive institutional suns just rising. ETFs with new superpowers, sovereign-grade asset accumulation. It's a lot.
It's the kind of week where the industry is forced to grow up a little bit. And growing up is complicated. Sometimes it's painful, saying goodbye to an old platform you loved. And sometimes it's just surprisingly heavy, like tons and tons of gold heavy.
Oh, we are definitely getting to the gold. I still can't believe the visual of that story. We have nuclear bunkers, federal charters, ghosts of 2016 coming back to life. But before we get lost, give us the lay of the land. What is the TLDR for this week?
Right, okay, the executive summary. Monday was the end of an era with Nifty Gateway shutting down.
The big one.
Then Tuesday, institutional adoption got a huge boost with VAVX Avalanche ETF. But with a big twist, it's the first to introduce staking.
Which is a massive technical shift we have to dig into.
Huge. Then Wednesday, Tether, the offshore cowboy of crypto, pivoted hard into the U.S. mainstream with a federally regulated stablecoin.
Wild.
But then on Thursday, Tether reveals it's also acting like a central bank, hoarding massive amounts of gold.
In a literal Swiss bunker.
A literal bunker. And to cap it all off, Friday gave us a blast from the past. The DAO, the entity that famously broke Ethereum in 2016, was resurrected to fund Ethereum security.
So we went from death to rebirth in just 5 days.
Incredible. Pretty much.
Okay, so our mission today is simple. We're going day by day through the articles from our newsletter, Nifty Noon, to separate the signal from the noise. We want to understand not just what happened, but why it matters. So let's dive in.
Let's start with Monday, January 26th.
Monday. The headline that hit me right in the nostalgia bone. The sun sets on Nifty Gateway.
Yeah, this is a significant moment. Nifty Gateway, the platform owned by Gemini, announced they are shutting down operations.
This one hurts a little. If you were around in 2020 or 2021, Nifty Gateway was the culture. It was the home of Beeple, of Pack.
Oh, yeah.
If you were up at dawn for a drop, you were on Nifty Gateway. And now, withdrawal-only mode.
That's right. A platform will officially close on February 23rd. The parent company, Gemini, says they're closing it to focus on a super app vision.
Okay, let's pause there. Super app. That sounds efficient. But is that just code for this business wasn't making money anymore?
It's likely a bit of both. I mean, in a mature market, companies have to focus on their core revenue drivers. For Gemini, that's their exchange and custody business.
Right.
Maintaining a niche art marketplace. That requires constant curation, artist relations. It's expensive overhead if the volume isn't there.
It is a shame, though. Looking back, the newsletter mentioned they paid out over $500 million to artists. $500 million.
That's a huge impact.
You can't call that a failure of impact. It was a cultural success.
No, absolutely not. But it does fit a larger pattern. This isn't an isolated event. We've seen other shutdowns recently, right? Kraken's marketplace, X2Y2.
So does this mean the digital collectible market is dead? Is the dream over?
I wouldn't say dead, but it is aggressively consolidating. The market is shedding its skin. We're moving away from that speculative frenzy of 2021.
Okay.
But what's even more fascinating is where that energy and the money is actually going instead.
Right, because while the NFT marketplace was shrinking on Monday, something else in the data was hitting an all-time high.
Exactly. Hyperliquid. The newsletter highlighted that their open interest hit an all-time high of nearly $800 million. $790 million to be exact.
Okay, for anyone who isn't a trader, what is open interest and why should they care about that number?
Sure. Open interest is basically the total number of outstanding derivative contracts. It's a proxy for how much money and activity is in the system.
So more money betting on the market than ever before.
Exactly. And here's the key part. They aren't betting on JPEGs. On Hyperliquid, it's largely commodities trading, derivatives.
So the liquidity is flowing from collectibles to hard finance.
It is. It's the financialization of the blockchain, which is the perfect segue to Tuesday, January 27th.
Tuesday was a big day for the suits. VAVX launched the first U.S.-listed Avalanche ETF on the NASDAQ, ticker VAVX.
Now, we've seen ETFs before, Bitcoin, Ether, so you might ask, why does another one matter?
Exactly. Is this just another wrapper for a coin?
The aha moment here isn't the asset, it's the structure. This isn't just a spot ETF where they hold the coins in a vault. This ETF includes staking.
Staking, finally. This has been the holy grail for a while. Why was this so hard to get into an ETF before?
Well, from a regulatory standpoint, staking introduces complexity. You're locking up the asset, you're earning a yield. The SEC has historically been very nervous about that.
They worried it starts to look like a security.
Exactly. But it seems VAVX cracked the code. They're aiming to stake up to 70% of the holdings. This bridges the gap between TradFi investors and on-chain yield.
So if I'm a traditional investor, I'm not just betting on the price of AVAX going up. I'm actually participating in the network rewards.
In a way, yes. The fund captures that value. And here's where it gets really interesting. VAVX is playing aggressive offense. They are waiving fees for the first $500 million in assets.
Wow. That's a serious customer acquisition strategy. That's a land grab.
They have to be aggressive. The newsletter mentioned digital asset products saw, what, $1.73 billion in outflows recently?
That's a big number.
It is. So launching a new product right now is a contrarian bet. They're betting there's an appetite for a more sophisticated, yield-bearing product.
It's a stamp of approval, isn't it, for Avalanche?
It is. It validates it as an institutional asset class. It provides a regulated pipe for capital that was previously just sitting on the sidelines.
So death of the old NFT hype on Monday, birth of staking ETFs on Tuesday. Now, Wednesday. Wednesday felt like a plot twist.
Wednesday, January 28th, Tether comes to America.
This is just wild to me. Tether, USDT, has always been the offshore guy, the cowboy of crypto.
Fairly or unfairly, yeah.
They operate in these shadows. They don't do the full audits. And then suddenly they launch USAT.
Yes, USAT, a federally regulated, made-in-America digital dollar.
It's like seeing a pirate put on a tuxedo.
That's a great analogy. But the tuxedo fits. USAT is issued by Anchorage Digital Bank, which is federally chartered. It's custodied by Cantor Fitzgerald. And the CEO is Bo Hines.
The former White House advisor. You don't hire a former White House advisor if you're trying to stay under the radar.
Exactly. This is a clear signal. They're playing the political game.
So why they already dominate the market with USDT? Why launch a compliant version?
I don't think it cannibalizes it. I think it bifurcates the market. This is a direct shot at Circle and USDC.
Ah.
For a long time, USDC's advantage was being the safe, US-friendly option. Tether is saying, we can do that too.
They are coming for Circle's lunch?
They are, and they're trying to capture that specific institutional liquidity that literally cannot touch USDT. Pension funds, insurance companies.
It's the key to unlock those funds.
Precisely. It's a bridge from the Wild West to the buttoned-up world of U.S. banking.
Speaking of hedging bets, that brings us perfectly to Thursday. Because if Wednesday was about embracing the U.S. dollar, Thursday was about preparing for its collapse.
Thursday, January 29th, the gold bunker.
This is my favorite story of the week. Tether CEO Paolo Arduino reveals that the same company that just launched a shiny new U.S. dollar stablecoin is holding 140 tons of gold.
And not just holding it, storing it in a Swiss nuclear bunker.
A Swiss nuclear bunker. You cannot make this stuff up. It screams James Bond villain.
The visuals are striking, but the economics are even crazier. They are buying 1 to 2 tons of gold per week.
Per week. That's nation-state level buying.
It is. That makes them one of the largest private holders of gold in the world. We're talking about $24 billion worth.
Okay, wait. What is the strategy here? On Wednesday, they launch US8, a bet on the US dollar. On Thursday, they're aggressively hoarding gold, a hedge against the dollar.
It's a strategic paradox, and it's brilliant. It's the ultimate barbell strategy.
Okay, explain.
On one hand, they're playing nice with the U.S. government to capture institutional flow. On the other, they're acting like a sovereign nation, building a gold central bank to hedge against global currency debasement.
So they're playing both sides.
They are. They're ensuring they survive any outcome, whether the dollar is strong or weak.
It feels like they're becoming bigger than just a company.
I think that's a fair assessment.
Okay.
And they aren't the only ones. The newsletter mentioned Fidelity is launching its own stablecoin, right?
Yes. FIDD on Ethereum.
FIDD.
FIDD.
Okay. But it just proves that the stablecoin market, $315 billion now, is the current battlefield.
And Tether is sitting in a bunker on a pile of gold, watching it all happen.
Incredible. But the week wasn't over. One more twist.
Let's move to Friday, January 30th. We start the week with a death, and we end it with a resurrection.
The return of the DAO.
Okay, for our listeners who might be newer, the DAO has a very specific, somewhat traumatic meaning in crypto history. Give us the quick version.
Sure. 2016, the DAO was this massive decentralized venture fund on Ethereum. It got hacked. It was so catastrophic that the community had to decide whether to reverse the blockchain to get the money back.
And they did, which is why we have Ethereum and Ethereum Classic today.
Exactly. It was the Titanic moment for Ethereum. It split the chain, and now you're telling me it's back.
A group of Ethereum OGs, led by Griff Green, supported by Vitalik himself, they're reviving it.
How? I thought the money was gone.
Well, there were unclaimed funds from that 2016 hack, about 70,500 ETH.
Which is worth what, $220 million today? That's not small change.
Not at all. These funds were in limbo. Now they're being repurposed for a new mission, the DAO fund.
And the mission is, please don't say another venture fund.
No. The mission is poetic. They're using the yield from these funds to finance network security, wallet safety, audits, incident response.
Wow, that is poetic. The money lost in the biggest security failure in Ethereum's history is now being used to protect it.
It really shows the maturity of the ecosystem.
Yeah.
We went from the DAO hack, almost killing Ethereum, to the DAO fund, using those same funds to protect it.
That's a great narrative. Speaking of the future, there was one other little thing in Friday's news about an agentic company.
Oh, yes. This is a glimpse into what might be next. News of a Twitter AI agent deploying the world's first agentic company.
Okay, explain that to me like I'm 5.
Imagine a company. No CEO, no employees, no shareholders, just an AI. It has a crypto wallet, it runs on stablecoins, it pays for its own server costs, it takes revenue, and it just operates.
So an AI running a business on the blockchain.
Exactly. If the DAO was humans voting on code, this might be the next step. Code interacting with the economy directly. No humans required.
That is both exciting and slightly terrifying.
It fits the theme of the week.
Yeah.
Old structures dissolving, new, weirder, stronger ones taking their place.
It really does. So looking back at this week, what's the big takeaway? What's the so what?
That's the question. How do you synthesize all of this?
I think the so what is that the industry is shedding its adolescent skin. We saw that with Nifty Gateway closing. The speculative JPEG era is fading. That was the teenage phase.
And in its place, the industry is putting on a suit.
Exactly. The Avalanche ETF with staking, that's a sophisticated financial product. USAT, that's a regulated dollar. These are tools for adults, for institutions.
And this is the key, it's also keeping a survivalist knife in its boot.
The gold bunker.
The gold bunker. Crypto is integrating into the geopolitical and macroeconomic stack. It's not just magic internet money anymore. It's in Swiss bunkers, it's on the NASDAQ, it's in federal banks.
It's becoming real. And the thing to watch is how the market reacts. Will USA actually take share from USDC? Will other assets get staking ETFs?
It's going to be a fascinating year. I have one final question for you and for our listeners.
Right.
Does Tether buying 140 tons of gold and hiding it in a nuclear bunker make you trust them more or less?
That is the multi-billion-dollar question.
Think about it. And for daily updates that dig this deep, make sure you follow Nifty Noon on X and Substack. We'll be there every day, separating the signal from the noise. Thanks for listening.
See you next time.